Glad you can join me, Stephen, man. It's always a pleasure to bring in someone of your level of expertise to share some light to various communities, man. So thank you for joining me for this conversation.
Oh, it's great. It's a great time to do it. Good times.
Hey, man, you know what? Holiday season, folks are always thinking about spending some money. We're closing in on January. Folks always have saving goals, and it's a great opportunity to take a look at that complete financial picture. And life insurance certainly is a big part of that. So glad you can chat with us. Hey, look, man, won't you take me through? Some people on this webinar may not know the difference between permanent insurance and term insurance. Let's start there at the lower level, and as we converse and as folks may chime in and have some questions, we can certainly go deeper into the woods. But let's just start with what's term, what's permanent, what's the various different types of permanent insurance. Tell us a little bit about yourself too before you start that, and we can kind of go there.
All right. I'm still getting some technical difficulties, but to share it, but we'll figure that out as we go. I'm Steve LeBroy. I'm a independent nationwide insurance strategist. Call myself chief strategist of the LeBroy Insurance Group. The ideas are simple. We try to break down insurance the way it's not been broken down for our communities over the last 150 years that it's been around. It's billions of dollars in this industry, and for the most part, it has not been utilized by people of color in the way in which the options are available. And when I say that, it doesn't mean that we haven't bought insurance or that there was not 60 plus African American owned insurance companies in our past that a lot of people don't know about. But what I say is that when it comes to strategy and how the IRS designates insurance, I think that a lot of us kind of let it go by the wayside. So, what we do at my firm is we bring that strategy to young adults, to professionals, to pre retirees, as well as to retirees, and show them how they can incorporate insurance into their portfolios and it be a huge benefit, not only a benefit for when they leave here, but Frank, also a huge benefit while they're here. And a lot of that has to do with the tax code. So, when you talk about permanent life insurance versus term, most people's definitions are very simple. They say term is cheap and permanent life insurance or whole life insurance is expensive. And that's the extent that I hear. Well, that's relative.
Sure.
I always say that when you look at life insurance, most people look at the first number, which is the number that you have to pay. And then they look at the number on the other side of the page, which is the amount that somebody gets when you die. Frank, you and I look at everything in between.
Yep.
And we try to help people understand the in between. And that's where usually the person that's buying the insurance can benefit. So, term is what we call renting insurance, where you pay a little bit of money and you get a lot of death benefit, very little other benefits except for replacing income if an income earner passes away, or you know they could possibly have, which all the new policies have on them now, what is called accelerated death benefits, which means that the owner of the policy or the insured can have access to the money in the policy if they become critically ill, chronically ill, or terminally ill. And it really is relative to the company and the policy. Permanent life insurance is what a lot of people know as whole life, but it also extends to index universal life, variable universal life, any policy that has a component of earning cash value is called permanent, but permanent also means that you keep that policy for your entire life. It never changes the price.
Hey man, that's a great point. And what about the different kinds of permanent insurance, right? Because most people just think whole life. And as we talk a little bit more and talk about the investment opportunities as it relates to insurance, I think what we'll discover is that whole life is just the surface of the apple. Is not really it's not the core or the part that tastes delicious. It's just a good way to kind of get an introductory into using life insurance as a savings vehicle. Can you expand on that?
Yeah, definitely. You know, most people would say, "Oh, whole life is an antiquated product." Well, it is probably the first piece to the pie that was set up by insurance companies in 1875.
Mm-hmm.
And the issue around it, it was actuarial science. So that actuarial science basically allows for an insurance company to help determine your life expectancy. So you put money in, and because they determine your life expectancy to be X, then they pledge if something were to happen to you between now and X, they would give you X amount of dollars. Well, again, that product continued on and it's still existing today. But insurance companies had to continue to get more and more creative because they had to also compete against Wall Street and the stock market. They had to compete against other products for the consumer's money. And for some reason, insurance companies are still around and they're still strong. They haven't gone through any recessions or depressions, but at the same time, they've innovated. So they've created this new product called Index Universal Life, which these products also operate and they grow based on what the market does. But ironically, the money is not in the market, so you don't lose your money. It just grows based on what happens in the market. They do calculations on your money based on how the market goes. So I think that's what we want, what you were hitting at. But that's something that I think a lot of people need to know about.
Now, IULs, very interesting product. And look, by the way, there's several people on with us. I just want to make sure they understand they have the opportunity to ask whatever questions they wish. Certainly, you have two licensed insurance professionals here on this live. Before I got my license, I'll be transparent. Steve was one of the guys that I would trust with my clients, or a person that I would make a recommendation to before I got my insurance license. So it's a great opportunity to pick the brain of a guy that's been in the industry for a long time, certainly knows his stuff, and answer any questions that you may have in regards to life insurance, particularly how to use it as a investment vehicle. So look, I want to stay real quick. IULs. So recently, I actually did an IUL with a client. Got another one that I'm working on with a client right now. And some people don't quite understand how you can participate in market-like returns, but don't take any of the risks that's associated with the market. Can you expand on that?
Well, I mean, simply this: insurance companies have created, well, let's start with this. A policy is a contract. So when I finally realized what insurance really is, it hit me like a ton of bricks. You know, a policy is a contract, which means that whatever's written in that policy is the contract you have between you and your insurance company. The position on it is if you're building a if you're building a policy and insurance companies will offer you the opportunity to participate in the market, then what happens is it's a part of that contract. And they clearly state that they calculate returns for you. They're called crediting.
Hey, Steve, are you still there?
Yeah, I think I did something. Let me stop this. Yeah, I'm here.
So I think one thing I was going to add why you kind of get that squared away on that end is what most people don't understand is how these things are structured, and they're structured in a way to take risk off the table for you and give you market like returns because they're investing in part of what they do is they buy an options contract. So if the market tanks and is down 30+% like in 2008, they just don't exercise those options so you don't lose anything. But if it's a year like 2009 where the market is up plus 30+%, there's an opportunity for you to participate in that up to your participation rate. But also you can add in riders that will you can use leverage and multiply that participation rate. So you can get potentially 15 to 20% without any downside risk. Is that accurate?
That's definitely accurate. You get deeper into it because you're in the securities world. Yeah, I just make sure people understand that what's written there is true, but I can appreciate that. That is definitely accurate. What's the key is no downside risk.
No downside risk.
That's
Very
the
important.
that's what you take home.
And look, I too understand that sometimes there's some sticker shock associated with it, right? It's like a time decay deal. The first year isn't going to be as glorious as year 5 or year 10, but certainly over the long haul, you're going to see equal or greater returns in such a vehicle versus, especially versus putting your money into like a CD or a money market or something that is going to return a significant amount of money.
Now that's key. And it's because it's the long haul. Because everybody that you talk to talks about how the S&P and the market always comes back.
Yep.
Well, if you simply don't lose, then there's nothing you have to come back for. You can begin at the stage in which the market starts to come back. I always make it real plain for my folks. And I just make sure they understand that if you didn't lose money in 2008 and your money stayed flat when the market went down, when the market started going back up, you started exactly at the point in which everybody else started to lose.
Yeah, man.
So,
That's go ahead. I'm sorry, Stephen. Go ahead.
go ahead. I'm sorry. I'm wrestling with my computer.
No, you good, man. You make a great point. So, one of the things that I always try to talk about is compound interest,
Mm-hmm.
and don't believe me as it relates to compound interest, but believe Einstein. We all talk about Einstein and we praise how smart he was. He said, compound interest is one of the wonders of the world. Well, part of wanting to use like an insurance product as an investment vehicle is you don't take compounding can work in both ways, right? So
Right.
people don't think when you're down 30% and then you go up 30%, you don't get back to even, right? So if you're down
Right.
one day 30% and the next day you're up 30%, well, now you're up 30% on the new number that you started off down 30%. So it don't get you back to the starting point, just going down and up the same amount of numbers, right?
That's
So
right.
if you can take that downside risk, that negative 30% off the table, and always be able to start from zero, that means that your compounding can happen much quicker versus playing those catch ups, then trying to compound from the catch up.
Hey, Frank, at least, and I always tell clients, it's also when you want to jump off. So
Mm-hmm.
you only have so many years to build this wealth. When is it that exactly the time you want to jump off and have money for your lifestyle, your savings, and your retirement? If you don't lose and you continue to gain, and then you have access to other products, you know, working with Frank and I, you can definitely put yourself in a position to jump off with a nice nest egg.
So look, let's talk about how do you use insurance in estate planning.
In estate planning,
Yes.
essentially, when you have your beneficiaries and you decide who and how you want your estate distributed, you know, you can name your trust as a part of your beneficiary, then the estate would take over and make the decisions that you want made, that you set up prior to to your expiration, and you create tax-free money going to your heirs.
Well, and that's what I was going to touch on. I was going to say, why is that important as it relates to investing? And you just mentioned it, right? Trying to take. So if you don't have it in place because you think, oh, you know what, I have so much money, I can be self-insured. That's great. You may have enough money to essentially be self-insured. But what you and I both know that once you die, right, especially if you at a certain level, that money's going to have to get taxed. Uncle Sam going to want a piece of that. So if you want to, again, it's all about hedging. It's all about managing risk in our world. So if you want to ensure that number that you had before I like to say, before your financial plan is over, right, at the end of your life,
Yeah,
you no longer need that money to transfer to someone else. So once
right.
your financial plan is over and you have to move that finances to someone else, you wanted to move at that number that you kind of had in your mind, not necessarily the number minus putting you in the ground, minus any kind of debt that you may have left behind or any final expenses. You want to make sure that in my case, I have 3 kids. I have a number that I want to leave each of them. I want to make sure that number is that number.
Right. But you also have the opportunity to use those policies while you're living. So, as we discussed, you have multiple options. And what some of my mentors would tell me, options and choices.
Mm.
So, even having more than one life insurance policy, as long as the contract is written in your favor or to have some favorable benefits for you, you create options and choices at various stages of your life. And when you're gone, those options and choices get transferred to your heirs. And when they talk about generational wealth, Frank, it's not a cliche, it's real.
Oh yeah.
Because we're also going to teach those young people how to take that and multiply it as well.
So look, I know you recently wrote a book on the living benefits, and I'll let you throw out the phrase that you kind of coined in regards to the living benefits of life insurance. But I just kind of want to tell a story. Someone gave this story to me, and you talked about creating wealth and using life insurance to do that. But there's a story someone gave me, and I said, you know what, this is kind of genius, and it don't spread to all communities. But a guy told me before, he's like, in certain communities, what they do is every younger person in the family, they pool their resources collectively, or they pool their resources to ensure the oldest member in the family, because eventually we know what's going to happen, whether we want to see it or not, is going to happen. But what they do is pour their resources, get the biggest life insurance policy they can. When that person passes, they make sure that all their expenses taken care of. The rest of it, they kind of pour back into the family, right? So some communities do those kind of things, some don't. Certainly, that's a way to kind of game the system to create some wealth. But like you mentioned, with the IULs, whole life, it isn't there just for when you pass away, but there's something that you talk about, the human capital, and you can kind of use those benefits while you're here. Do you mind talking about that?
Yeah, no, certainly. I'm at the 1 year anniversary of my book, Build Your Human Equity Line of Credit. So, Build Your Human Equity Line of Credit was a term that I coined and I actually trademarked it because it came to me based on the fact that normally people think about home equity line. Home equity line simply is collateralized by your house, but it's controlled by the bank. If you understand that, most people with homes know that they have to go to the bank to control any kind of money in their home. Well, guess what? A human equity line of credit is controlled by you because you're the collateral. Long as you stay in shape, long as you're qualified, long as you're underwritable and your medical is in position, you can create these contracts so they benefit you. And you're talking about companies with billions of dollars and no debt. So we're talking about leveraging things that other cultures take for granted. And we have to pull in some of these resources. I wanted to make one point, Frank. One of the reasons I love life insurance, and most of the people that know me know I had a different career prior to this, but one of the reasons is that it's one of the only tools that you get to look at the possibilities before you sign up.
Mm.
When we do our illustrations for clients, they get to actually look at it, change it around. They get to actually ask you questions before they even fill out an application in most instances. Other products, and they get to see what the potential of the earning can be. Other products, you have to sign up and you have to hope that it turns out that way. The only thing people are always concerned about often, well, what about these insurance companies? Whatever happens if you have happens to an insurance company? Well, Frank and I will tell you emphatically that we don't know, but what we can say is that the majority of companies that we work with, and there are over 543 life insurance companies, you can Google it. Majority of companies we work with have been around over 100 years. Now, what companies have been around over 100 years? Heck, the ones that were around over 100 years and that were number one on the Fortune 100 chart are being surpassed by Amazon and Google and those companies now. Insurance companies are just gliding along
Mm.
and they got no debt and billions of dollars. But I wanted to make sure that I said that too.
So there's who's the GE in the insurance world? I think that's when you said these historical companies. I'm assuming you mentioned like GE and guys like that, Kraft that's
Yeah,
been delisted and back on the market. And I'm not throwing anybody under the bus, right? So
right.
don't I got to throw out the the unfortunately the disclaimer that I'm not talking bad about GE or Kraft. Those could be great investments, but I think to Steven's point, um, you just never know where some of those companies are going to be 100 years from now, versus a company that's been growing or staying afloat for 150, 200 years, kind of even steady, knowing that you're going to get the kind of returns you want to achieve the goals you want.
Yep. And one of the things that I want people to really understand, it's not an or product. I don't tell you because Frank, got licensed to do all types of great investments. He's a private wealth professional. Insurance is not an or product, it's an and product. It basically is the rudder underneath your portfolio. It's the stanchion underneath your building. It sits there and doesn't move. It's like a rock because it's a contract. The policy is a contract. And the government is behind it because the tax code 7702 allows for all the growth in the policy to be tax free and for the use of that money to be tax free. So understand, all we got to do is help you build in application that extends wider than when you're gone, or that extends even stronger than the reason why you don't want to spend X amount of money into a policy. Because one of the things Frank and I show people is that it's a deposit into an asset that you own. A deposit, not an expense, a deposit. So, I love to try to make sure that it's plain and make sure that we understand that this is what I call the miseducation of life insurance. And we got to change that paradigm, Frank.
Man, so look, I'll be honest with you. When I first got into financial planning, like I stayed clear of annuities, and I probably even bad talked them, to be honest with you. Annuities, life insurance. Oh man, that stuff isn't a great investment vehicle. And then once I really dived deep into it, I think you and I had a conversation, and once I got licensed and learned more about how they're structured, I'm like, you know what? This makes a great deal of sense. Like I'll share something that I'm sharing with all of my clients right now, and is all right. So interest rates, we hear about interest rates, just about every day. If they're going to go up, they're going to go down, and interest rates compared to where they were, 1980s, we're hovering about 12% lower than where they were at that particular time. A perfect opportunity to guarantee or to lock in, not necessarily guarantee, but to lock in an interest rate that's higher than what you're going to be getting right now. And in the future, as things move forward, probably what you're going to get in the future is to use a life insurance product. So one of my stories right now is, how do we use an IUL in place of your fixed income portfolio so that we can lock in something like 4 to 5% and not even worry about interest rate risk in our portfolio. So now we can almost slam dunk that 5% because we consider it our fixed income portion of our portfolio, and then we still can chase higher returns in the market. So like you said, Stephen, it's not really a either, a one versus the other. It's how can I use this as a complement to my strategy, taking some risk off the table and preparing my family for life after me if that so happens.
That's right. It's a compilation of things, and I even go one step before that because I get into talking with clients about money management strategies. So money management means, how do you manage your food, clothing, and shelter? What are you doing on your day-to-day basis? Frank, if we are, as African Americans, the number one consumer culture in the world, that means that we spend almost everything we make.
Wow.
And I understand that. I've been around for 54 years. But at the same
We've all
time,
bought Jordans before, right?
plenty of them. And see, I'm before you. I had some leather Converse for Dr. J. So, so, so you understand that at the end of the day, what I follow is a doctrine called infinite banking,
Mm,
where you can use that whole life policy, using some riders and some additional components to the contract to create a bank of money that you can have to use throughout your life for whatever it be for. My clients are borrowing money from their policy to pay bills, to take vacations, to buy equipment for their dental practices. And so it's just a matter, I use the money in my policy to manage my business and the administration and the marketing of my company. So I don't just speak about it, what they say, I be about it. And I use that term on.
mm. Yeah, don't just speak about it, be about it. So look, that speaks to what you talked about. If you view kind of this cash value that you build in these policies or these contracts, if you think about that, the contract as an asset, and you really can leverage it to take and a line of credit against it, you can use it for whatever you want to use it for. And when you pull those, let's say if you use it for retirement, when you go back to pull those, often you can pull that stream of income without having to pay any taxes.
Well, guess what? There's so many strategies And additional to my book, I found over 20 plus books that talk about this. In fact, one of the first things I do with my clients is send them my book list because, once again, some people tell me this sounds too good to be true, Frank. They say this sounds too good to be true. What is this about? And I say, hey, guess what? I didn't discover it. I'm just trying to make sure that we're aware. If I leave this earth tomorrow, I made sure quite a few people are aware that there's more to insurance, to life insurance, than meets our eye. And
Hmm.
when it comes to using it for various reasons, heck, I talk to clients about building the whole life policy up, pulling money out, and putting it in an IUL.
Hmm.
Because guess what? Some of the gurus in the strategy that I employ have 15 or 20 policies. Sometimes that's unfathomable for people. Why would you have more than one policy? Well, you got 15 or 20 guarantees, right? And then you can take that money and do other things with it based on the economy, based on your age, based on your health. You have a turn in your income, you got money available. So understand, sorry about that,
No, you fine.
understand that, it gives you a lot of flexibility, and there are a lot of people out here talking about it. And I'm just saying that, you know, don't ask me, ask Alexa. She'll tell you all the stuff you need to know and confirm exactly what we're saying. So,
So, so look, man, I want to be mindful of your time, and certainly, I think the expectation was to be on for maybe like 30 or so minutes, and we're up against that in I think an hour right now from the time we were supposed to start.
yeah.
Unfortunately, I had some technical difficulties, so I appreciate everyone being patient with me in regards to that. But look, man, I want to give those that still with us an opportunity to ask any questions if they have any, and certainly if there's some other tidbits you would love to share with the folks that's on with us now, and certainly to live in eternity on Facebook's world. Won't you give us your parting tips? And also,
Well,
how would one reach out to you if they feel like they've enjoyed some of the things that you shared? Maybe they want to get your book. Maybe they want to throw some ideas at you. How would they get in touch with you?
well, no, I appreciate this, and I hope we can do many more to continue to bring this to the audience. As I told you, I think, this is a nationwide conversation in the midst of an industry that's been around 100 years. You can always reach out to me through Facebook, Stephen LeBroy, LABROI. LeBroy Insurance Group is the name of my company. And then if you'd like a copy of the book signed, just StephenLeBroy.com. You'll see the website, and I'll get the information, and I'll send it to you direct. Or Amazon, Audible for those people that like to listen, or Kindle. So this was great, Frank. I'm glad you called me and said, let's do this. And again, I hope we can do this again.
Hey, last thing, pardon tips.
Uh,
One good strategy they should be employing right now using life insurance.
well, one good strategy I can tell you this is know what your policy is. People put those policies under the mattress and never look at them again. They just let the money come out their bank account. Pull it out and read it. How about that one? And then either go back and talk to the person that sold it to you, or come and talk to somebody like me and Frank to be able to update it. Because guess what? If you bought a policy 10 years ago, 15 years ago, it's just like having an old car. You know, if you get a 2019 version, it might fit you a little more snug at this point based on how your life has changed. So don't think that a policy you've had for 20 years is still going to be something that's going to fit you 10 years from now. We've had grandma pull those policies too many times, you know, she's had for 20 years, and then next thing you know, the policy doesn't fit. So let's know what we have, and I think, that's the first place to start.
Hey man, that's great advice. And one of my practice, part of my service model, annually we do an insurance review, and I think to that point, I think everyone should do, in addition to having a financial fitness, looking at your entire financial picture to see where you are and kind of track things. I think you should add in there an insurance review to make sure, one, you have enough coverage, life changes, lifestyle changes. You want to make sure that you're covered on what your lifestyle is today. But certainly, like you said, there's improvements to things and new things added into the industry that could work better for you than something that you had yesterday. So try to make that a practice, and certainly reach out to people like you, Steven. So look, man, I appreciate you coming on, chatting with my Facebook friends and certainly yours. And we'll definitely do this again soon.
Okay. Thanks, Frank. Hey,
All right,
be
Steve.
good. We'll
Yep. Have
talk
a good
soon.
one, man.
All right. Take
All
care.
right. Bye bye.